Hey guys, it's Max. How's everyone doing? It's beautiful, kind of brisk Saturday morning here in Austin, about 45 degrees this morning when I woke up. Beautiful, not quite a frost yet. Okay, I made a bone up on options yesterday afternoon. That was actually a good episode, but I forgot to share the screen, or I thought I had shared the screen, but I hadn't. And of course, you guys told me in the comments. So I'm not going to redo the same episode, but I want to talk about some option trading concepts and some option theory today. We're going to look at two different kinds of trades, and they're trades that people use to hedge commonly, and that I use to hedge, and they're trades that I've been recommending. But we're going to take a look behind the trade, see what makes it work today. So if you're interested in that, stick around. And then we're going to look at also, I'm going to show you guys what I do to make an apples to apples comparison. Anytime before I make a trade, I give it a test, and I'm going to show you the max test. Okay, so let's first we're going to talk about what's called a call ratio back spread. Hedgers love this one. Hedgers love this strategy. A few weeks ago, there was a Peter Zeihan video where he talked about that he thought there was a 1 in 4 chance of oil could go to 300 by the end of the year. This was like a month ago. Now, obviously, that hasn't happened. But anyway, I used the video to show you guys how to do a back spread. And this was the trade I recommended. This goes out till January 17th. And at the time, it was like around mid-October. About a 3. This takes you about a quarter into the future. What you do here, this is USO. We all know about USO if we have Defiance because they have USOY, but USO is an ETF that trades oil futures. So this is a way, if you don't have a futures account, which most people don't, this is a way you can get exposure in a stock account to the price of oil. Okay. And this is US oil. You can also, this keys off of the West Texas Intermediate contract, I believe. There is another one called B&O, which is Brent North Sea, that keys off the Brent North Sea price. I don't know much about the options in B&O, so we just did it in USO. So what the strategy is, and the price of USO corresponds to the price of oil. So it's trading around 70 right now, just like the price of oil roughly corresponds to it. It's roughly equivalent. Okay. So what we did at the time, I think it was a little bit higher. What you do in these types of trades is you sell an at-the-money option, an at-the-money call. To do a call ratio back spread, you sell an at-the-money call. So at the time, this was at the money. And those usually are pretty expensive because it's at the money. Say it costs $10. Okay. Then you go out of the money and you find a call that say costs $4. Okay. And you get 2 calls that cost $4. 4 plus 4 is 8. All right, so you're spending 8, but you're bringing in 10. So you're actually bringing in 2. These trades can be done at a credit. And so that's what you see here. So I gave you guys an example. So in this one, we'll just look at the actual trade. This was sold for $6.68. And these options that were, 10 strikes out of the money or 12 strikes out of the money, it's the 85 strike level, were $2.50. So you could buy those twice for $5, but then you could bring in $6.68 on this. Well, the difference is what? 156. There's your credit. Okay, well, look at what that does. It sets up a really nice situation on a profit and loss graph, because when you take in a credit for a trade, even if you aren't right, this is a bullish bet on oil. This is a bet that oil goes up. Okay, but even if you aren't right, in fact, if you're wrong, if you're exactly wrong, you still get paid. The trade, because it's a credit, you just get to keep your credit. So in fact, you're hoping that you're either right or that you're wrong, because this trade doesn't even cost any money unless you get into the valley of death. And you can see that right there. All right. So that's the call ratio back spread. That's, like I say, that's hedger's delight. If oil goes to, let's do this here. If Peter Zeihan's right, and he's not right that often, but if he was right about this one, that this contract is on one option would be worth $20,000. So if a person was at all worried about that happening, if you had anxiety about oil, even if you didn't believe Peter's Ion, if you're afraid that maybe the world's going to go to hell in a handbasket, this is a good hedge just to have on in general on your, and the reason I say that is because it really doesn't cost you anything. If you're wrong and the price of oil goes nowhere, keep the credit. If you're wrong and the price of oil goes down, keep the credit. All right. So anyway, I'm going to show you guys, but this trade's obviously not without risk or consequences. So I'm going to show you a way that I decide whether to do this trade or just to go ahead and buy a call. Sometimes it's a better idea just to buy a call and not to jack with all this complicated stuff. Okay. So here is the way we're going to do an apples to apples comparison. Then I'm going to show you another trade on the SPY in case we aren't interested in oil. But this is I have this trade. This trade is a good trade. This trade is a good trade. Because it's a good hedge for the rest of your account. Because if oil did go to not even 300, say if oil went to 150, think how much that would mess up a lot of your other investments. Well, the good news is this would be worth 5,400 a contract. That's probably not enough to hedge you very much, but you could do this 10 times. If oil goes up to 150, it'd be worth 54,000. But if oil goes to 300, it'd be worth 200,000. And I mean, like I say, it's pretty good when you consider it doesn't really have it doesn't have a true cost. But anyway, we're going to look at the true cost. So here's what you do in option strat. All I do is I hit duplicate tab and it'll bring open the same position over here. And I've already done this beforehand. And all I did is I want to compare just the 85 call. Because on this one, we're selling the 73 call twice, or selling the 73 call to buy 285 calls. But really, the true position, the true money maker, the true hedge is the 85 call, right? Well, so I just get 185 call, and you can see here. So let's look at this trade's chance of profit, 4.3%. Okay, we'll look at this trade's chance of profit, 70%. I prefer to do it this way. It's not without problems, though. You have to have $1,000 to do it this way, because the max loss, the bottom of the valley of death, is $1,000. Now, you don't lose that much every time, but they're going to make sure you have the ability to lose that much. So you have to have more money to put on the back spread rather than just to buy the option. You could just buy the option. It's basically the same thing. Oil goes to 150, it's worth $5,400. Oil goes to, it's the same thing. It's very similar profit and loss to what I just showed you. Let's see, at 110, just buying the options worth $2,200. At 110, the spread idea is worth $1,400. It's the same thing. It's the same thing, basically. But that's how I compare it. So then you have to tell yourself, okay, so heck, what would I rather do? Would I rather spend $1,000, and they're going to take that out of your account, and it's going to stay out of your account until this expires in January, or until you take it off. But it's not designed for you to take it off. It's designed for you to leave it on and just let it expire. All right. So, it's going to cost you $1,000 in spending power. So that's something to consider. However, you have a 70% chance of profit. Okay. Now, on this one, do you guys know how see this big thing that looks like a ghost in the middle? That is what are those things called? That's called a bell. It's a bell curve, but it's a graph of your expected results. Your expected 3-month results over the next, whatever, you can move this. I'm not going to do it because I don't want to mess it up, but I could move this out to January 27. The ghost will get bigger because what it does, it takes the option prices from January and it implies the statistical implied move, and it sets this bell curve looking thing over it. Okay. Well, the bell curve, the whole curve contains 100% of occurrences. Okay. Well, you can look at these hash marks right here. So between the first hash mark, see how it says 83 right there? And then you go to the other one, it says 83 the other way, but 85% of all occurrences occur inside this. Now, when you get, see over here, when you get past it, it says 15 or 16. So when you get outside, those are called the tells. That happens 15% of the time. So from the middle to here, if there's an up, let's put it this way, if there's a bullish move in oil from the middle to here will contain the move between now and January 17th, 83% of the time, if there's a bullish move. 17% of the time, it might get out of that. 3.7% of the time, statistically speaking, it might get outside of that. Okay, well, when you're buying options, you're playing for the tell event. And this is a hedge, so that's kind of fine. You do it this way, it's going to cost you $255. That's all it's going to cost you, but you're probably going to lose that. It's gone. You can just pretty much consider it's gone. When they talk about options bleeding, this is what they mean. Options will bleed your account, because otherwise people could just buy a put and just keep hedged at all times, and you never have to lose any money. If options, you know what I'm saying? If options didn't have a premium or didn't cost anything, you could do all kinds of crazy stuff. So what we're doing as option traders, when we're selling options for an income and creating complex trades like the kinds I tried to show you guys, and a lot of other people do too, you're trying to create a better situation statistically for yourself. That's all it is. You're just hacking the expectancy. I mean, that's one way to look at it. Okay, so this way is going to cost you $250, and you're probably going to lose it. In fact, you're going to lose it 96% of the time. Okay, this way is going to cost you $1,000, but 70% of the time you're going to get $156 back 100% of the time, plus 70% of the time you're going to get to keep that and maybe even get some extra. Yeah, that's the way to look at that. And look at that. It makes sense, because look at the bell curve. This bell curve's skinnier because I have it zoomed in more. I mean, it looks skinnier, but I could zoom it out more. But it's the same. It's the same thing. So see, and this is why this trade's so powerful, because look how much of the curve is on this side. See that number 67? 67% is on that side. So it's going to be an automatic winner. And that's what I'm saying. When you're wrong, you get paid, essentially, because you just get to keep the credit. Okay, well, then you have about 3% over here that's on this far right side. Doesn't usually come true, but I mean, if it does, you get paid on that. So that's how it's 67 plus about 3. That's your chance of profit. The bell curve is it just helps me, and I'm hoping to help you visualize how options work. So an option, you're just trading the expected move. When you buy an option, you're saying, hey, Mr. Market Maker, this fucking thing's going to move more than the expected move. You don't have this priced high enough. When you're selling an option, you're making the opposite bet. Okay. But when you're doing both, when you're selling one option and buying two, the market maker doesn't know what to do, because you have him. I mean, not really. He knows what to do, but you know what I'm saying. I think this is a great way to play this. This is why I show you a lot of these kinds of trades. But I just want to tell you guys that these kinds of trades aren't appropriate for everybody. If you listen to me and you believe Peter Zion and you think oil might go up and everything, let's say you have a small account. Let's say you're trading with $1,000 account instead of a $20,000 account. If you're trading with a $20,000 account, this is the appropriate way to make a hedge, in my opinion. Ties up about 5% of your account. Okay. If you're trading with the $1,000 account, that's fine too. I mean, nothing wrong with that. But you're going to be, this is going to be your strategy, because you're going to have to, or this becomes the only strategy that you can do. Now, you can also sell options in small accounts and try to make them where they aren't small accounts anymore. And we'll have some content on that. My point is, the first thing you have to do is tell yourself, can I afford to tie up $1,000? Would I rather tie up $1,000 per contract? I mean, you can do it more than that. You don't have to do one contract. If you say it's not big enough for me, well, whatever, multiply by 10, multiply by 100, whatever you're comfortable with. But can you afford to tie up X amount of money per contract, $1,000 per contract? Or would you rather tie up $250, with the caveat being the $250 is probably gone? I'd rather tie up the $1,000, because I'm trying to because I don't really think anyone really knows what's going to happen to the market. And when you do these option positions that have a 70%, hit rates, then you're going to be fine most of the time. You're going to get your income that, because the odds are in your favor. And occasionally when someone like Peter Zeihan's right and one of these crazy things comes true, or you remember I was thinking that the Democrats would contest the election and we'd have a civil war. And I was thinking all kinds of awful stuff, but none of it happened. Anyway, so that these kinds of strategies are great when you're wrong. And you have to admit to yourself that you're wrong a lot of the time. But you only have to be right on one of these things every once in a while to make a shitload of money. And I think I know you guys get that. So, and the other theory is if you trade like this, where you make an income and you can take more swings, you can keep your account liquid longer. So you're around whenever Peter Zeihan is right. And you have the $54,000 winner. And like I say, that's per contract. If you have this on 10 times, it's $500,000, So anyway, all right. So let's look at the other example that's a hedge trade. I'm going to quit talking about the oil trade. We're going to shift gears. I'm so sorry that I did the whole episode yesterday without the screen being up. This is like a makeup episode. Okay. This is another example. But now this is an example. I'm trying to remember the scenario for this example. I have so many scenarios. Well, this was just a scenario. Oh, I know what this scenario was. This was a nice scenario. Let's set this up really quick. Anyone who watched the live show yesterday would see it. Okay, this right here is a chart of the SPY. This right here is a gap between the night that Trump won. The people were right here thinking like me, oh, this is going to be a contested election, more volatility to come. That's what everyone thought. Boom, whenever the news came out, Kamala, she conceded, everything was fine. Joe told Don, come over to the White House. They shook hands, made nice. Okay, boom, market's off. All right, well, that happened overnight. That happened overnight, but what tells you a lot is the price that didn't trade. That's called a gap. And gaps are very strong technical things that people that day trade and short-term trade look at. There's a video out there on the internet by Mike Jones, and he's talking about this gap, calling it the Trump gap. I'd call Melania the Trump gap, but or more like Stormy, but it's however you want to look at it. And I didn't watch his video because I didn't want to be influenced by what he says. But I bet he's going to say what I'm saying. This thing, it will draw prices back into it. But if this thing was real, it'll shoot prices the other way. This is a great place. It's a great place to take a stand. You know where you're wrong, because if it goes the other side of the gap, you're wrong. And then it's the other side of the gap is the market calling BS on Trump. And that could happen too. But I'm saying as of Friday, it dipped its toe into the gap, popped out. So that's the scenario of my trade is, okay, well, this pullback was fake. This gap is going to be supported. The bulls and everyone who bought this, everyone who bought it this day is going to come back in and buy it this day. It's going to be a supported gap. We're going to take off and go the other way. That's the scenario. Okay, so how does a guy make money off that? Well, a couple of ways. The old way to do it would just be this is the way I used to do it. You kind of used to have to do it this way before commissions were free. You just had to take a shot every once in a while. But in other words, you just take a shot. Okay. So this we're going to look at that, but you could either take a shot. This expires next Friday, so it's a week, and this was put on at the close on Friday. These are based on Friday closing prices. Okay, this is a smarter way to do it, or this way, taking a shot's a 16% chance of profit, and it's the same thing. Look at the bell curve. You can go over here, see that number 39, 34, 30, 20, 10, 16. That means 16% of the occurrences are over there. The rest are over here. Okay. So that's why that's how you come up with 16%. Okay. Now I show you guys this trade all the time. This is not in option books. This is not even the way Jay does this. Jay does his same trade. This is a risk reversal. Jay does this with two spreads. He'll sell a put spread to buy a call spread and do it without stock. And I call that a loaded dice trade because it puts the odds so far in your favor. But what I figured out, you really just, then I modified it. And this is a better way to do it because a loaded dice trade doesn't have unlimited. It's not a better way to do it. This is an option. This is a way to do it if you want to load a dice with unlimited upside. Sometimes it's better to do it the way Jay does it, a loaded dice with limited upside. We'll look at that as well too. But for today's episode, I'm trying to say we're trying to buy the dip and spy. So we're thinking, it might be up 5% next week or something. That's what I was thinking. Just but this is a decent way to express an opinion. Because when you sell a put spread to buy a call spread, you give yourself a huge buffer. That's the loaded dice element. SPY can drop 1.4% and you still just get to keep the credit. It's $196 credit. It's going to tie up $1,600 in your account for 1 week or until you reverse it. Okay. But you don't realize the trading loss unless the SPY drops more than 1.4%. So 1.4% is 577. Let's see what that looks like graphically for those of you guys. Oh yeah, I put it on here already. So that's that. Unless the SPY drops under that line, let's pull the line out to Friday. Let's see what we're really betting. My Friday. There we go. All right, that's the bet. We want to keep this damn chart above this stupid line between now and Friday. We get to keep the credit, which is like a 20% winner, 20% winner in 5 days. So that'll be fine. It's not really what the primary bet is. The primary bet is, of course, that we go up 5% from here. But, let's just say a new high. So new high even would take us to 61.55. All right, so let's take a look. All right, 61.55. So that 61.55 would be around 650 for the SPY. Jackson, what are you doing? Knock it off. All right. That'd be a $1,500 winner. That's kind of what you're really kind of hoping for in the back of your mind. I'll give you guys a free way to play it or a cheap way to play it because you could do it this way and you have about a 78% chance of profit of just making the 20%. And if you're wrong, you lose $1,600, no doubt. But there, if you buy shares, you compare this to buying shares, which some people do day trade. If you're wrong, if you're wrong buying shares, you could easily lose $1,600. If a lot of people trade at the money options and different options, you can easily lose that amount of money. If you're wrong, anytime if you're wrong, you're going to lose $1,600. So what I'm doing is hacking the expectancy and saying, okay, it's not like I'm doing this. I copied it off of option traders have been doing this. Market makers have been trading like this way since the beginning, since the 70s, because a market maker can trade without commission. They have a seat on the exchange and they can trade for lower cost. So they've been using things like back spreads and stuff to hedge their own books for years. The way I figured all this stuff out is by watching Tasty trade for 10 years or a lot of this. I mean, the market maker, his only goal is just to stay balanced. Tasty Trade will show you every trick in the book to stay balanced. I mean, there's zebras, there's back spreads, but they don't talk about the max convexity spread. They probably do, but I have not seen a three-legged spread, a 3x1 put spread this is a badass trade. Anyway, okay. But let me show you an apples to apples comparison. I just think this is a better way to do it. But an apples to apples comparison would be just to line it up this way. So this way you'd only lose $86, but it's going to happen, most of the time. This way, the way I look at it, even though it costs $1,000, you have an 80% chance or 78% chance of profit. So the way I think in my head is take 80% of 1,600. So you have to take 320, 1,600 minus 320, whatever that is, 14 something. 1480 or 1380, something like that. That's about, oh no, not even that. What you're really risking is just the 320. Now you're risking more. The market maker's holding out 1,600, but in my head, I think of the risk as just the inverse of this, just mathematically. But anyway, that's just the way I think of it. But it doesn't matter how I think of it. The market maker's going to hold $1,600 out because that's the max loss. He'll just hold that out and see what happens. I just think this puts you in a huge advantage. You're gonna make 20% return on your investment So let's see. How do I figure this? You're going to make 21% return on your investment. What's 77 minus 20? 57% of the time, you're going to make 20% return on your investment. 57% of the time. An additional 15%, you're going to make that much and more. That's why this is such a powerful trading strategy. Like I say, it's not in any books that I've seen, and I've read them all. But also, to be honest, I copied it off Jay. But I'm going to ask him why he doesn't leave one side. All I'm doing is leaving one side open. And I think I know why. But we'll talk to him about the metrics he uses and how he compares it, apples to apples, on Wednesday. All right, so let's go back and let's look at the option trades for the week. And now that we've kind of reviewed on kind of some stuff I like, let's kind of see how they worked out this week. We can even look at some closed ones too. But on the active ones, the one I just showed you is up $22, whatever. This is an NVIDIA one that is actually doesn't expire till next whatever. I was just trying to. Oh no, that was a ULTY trade. Okay, I'm not worried about the ULTY trades. Okay. Now look at this one. I did this one. It says it's down 5,000. I don't believe it. It doesn't expire for 45 days. And I did it not in real life. I did it on paper the morning after the election. I got up and I wanted to see if someone would have put a max convexity on that day for the end of the year, what would have happened. And the market's actually pulled back a little bit from there. And it's actually about to go through the buffer. You see, because this thing, the trade that I simulated had buffer. This is in the SPX down to 58.32. So let's get the SPX out here. So when the trade was simulated, the market was right here. Okay. And the market's still right there a few days later. Okay. Well, in any event, this ought to be interesting to see. I just wanted to see, I mean, this would tie up $50,000 out of your account. I mean, that's why I didn't make any content on it. I'm not recommending this. I mean, you know, everyone that watches my channel hopefully is already up big on the year. And at this point, we're trying to keep from, we don't want to add more risk at this point. So anyway, I just thought it was interesting to look at. I want to see, you know, how much this Trump phenomenon is really worth between now and the end of the year. But in any event, this would be a way to do it. You could have made $4,500 profit. You'd be rooting for the stock, you know, the market to be up the rest of the year, and you're fine. And if, you know, if the Trump thing is real and the market's up, I heard Tom Lee say we'd be up 40% at the end of the year. We're up 20% from there. But I mean, when he said it, or up 10% from there. But let's say we're up 20% the rest of the year or something, 90 grand on this thing. Now, I'm not saying that's going to happen, but it's kind of like a free or a cheap shot. Let's look at what the true risk is on here. Or the true risk is $47,000, but let's look at the mathematical risk. 55% chance. So we'll take the inverse 45%. So about half. So basically, when you put this trade on, you're basically kissing $25,000 goodbye mathematically. Now, it doesn't mean you won't get some of it back, or you can't kill it, but just mathematically speaking, just using that. In the same way that you can say you're kissing $86 goodbye when you do this trade. You aren't really kissing 86 because you have 16% chance of profit, but 16% of 86 is like, anyway, so you're kissing $85, whatever. You're kissing $80 goodbye, essentially. You're kissing 85% of it goodbye, 85% of $86. Jax, what are you doing? All right. Well, I wanted to do a makeup option show since I felt bad that we you know, that one the other day, I didn't share the screen. I love to share the screen. This isn't, I'm not going to show you guys that trade. That's because I have content coming out on that trade. All right. Well, let's just kind of go through and see how everything else is going. So this Disney spread, and I showed this one to you guys. This could not have gone any better. I mean, this is what you're playing for. This is a loaded dice that worked out. Now, this one doesn't expire till next week. So that's the way the line looks kind of funny. But look, if you draw the line through, but two things. First of all, you could take this off, and I would probably recommend it if you put it on. Take it off right now for $1,300 profit. Don't hold it for an extra week just to let the market go correct. But if you're bullish on Disney, it's basically like owning stock, because you could hold this. If Disney's price keeps going up, your $1,300 option trade could turn into a $3,000 option trade. There's still plenty of upside. The upside on this trade doesn't kick in until 123 on Disney. So this is the way Jay does a load of dice. I was just talking about the Jay load of dice. This is the way Jay does it. Mine would just, I take off a leg here, so it just keeps going up. That's the only difference. It's not a big deal. It's not a big deal. I'm sure Jay will probably be watching the show this weekend, and then he'll probably start doing this next week, right? I'm sure he's copying off us. You know he is, right? No, we're copying off him. But this is a fertile soil. I haven't had this many good trade ideas in years since I started watching Tasty Trade and started really studying options again. I got a couple of good books and read them cover to cover, and that got me going again too. But this type of trading, loaded dice trades, you can do these bearish loaded dice trades too when the market turns around. Sell calls to buy puts. It's not quite as advantageous because of the way option skew works lots of times, but it can be adjusted. The trade can be adjusted to be bearish. All right, I was just seeing what dog that was. But yeah, this Disney trade, I mean, you know, usually any type of option selling strategy, you have capped upside, and that's the main knock. Well, yeah, you have capped upside, but hell, not till like 125. Let's look at Disney's chart. That's what I love about it. What I like is I like economy. This Disney trade was an options earning trade that you put on before earnings came out, because it's a volatility play where you just make a little income. It's easy, right? But at the same time, you can turn it in, or when this is Jay's strategy. Jay has figured out how to turn it in to a bullish bet on the company. Somebody asked me, it was Tom, and this just occurred to me. Tom said, I wonder why he did the Disney trade for next week. Maybe that's it. Maybe for whatever reason, he wants to make an income, which he did. At the same time, he wants to make a bullish bet in a bullish play in Disney. Because look at this. Let's break this down. Okay. So this is a gap. You can look at this like the Trump gap. Bullish above, bearish below. If this fails and we get underneath it, it would not be, technically, you would want puts. But as long as it's above it, I mean, we'll see. We'll see. So let's look at this. Let's look at this. Let's evaluate Jay's position. But I'm with Tom. I would have just done it for 1 week, and that I simulated it for 1 week, and it came out $300 better. But but I mean, Jay and his traders, they want the income, but they also have a target of like 130 on Disney. Well, anyway, this would be a decent way to express the opinion. Yeah, if it really gets to 130, you leave 5 points on the table, but you're essentially playing stock from here. This 45 up degree line is just like stock. I'm trying to think of a way to show it to you, but in any event. All right. Well, that Disney trade was badass on both Jay. Jay did it. I have on the ULTY version, but then I showed you guys how to do it. And I just call it's the max convexity spread. Okay, here's a loaded dice spread that did not work out. So let's say I don't always work out. Let's see what the hell's going on. And this was a bullish bet on DJT. So this was another thing I did on election day. I thought, okay, well, wonder if because Trump got elected, this thing does go to 100 or something. How's a way that I can play that I can afford to play that? This is what I came up with. So, but since then, I think DJT's price has fallen, but it's not that big a deal. You lose $1,100 if you're wrong. I mean, it is a big deal. But I'm saying you lose $1,100 if you're wrong, but basically, like I say, between now and then, it's like stock. You make anyway. But the main thing you're going for is that $360 credit on $1,100 risk. That's not bad. That's like 25%. It's for a quarter. It ties up your money for a quarter. So that come to 100% a year? That's not bad. Not a bad. So that's a decent income trade. A guy could do a reverse version of this too if they were bearish on DJT. Okay, so that's an interesting trade. Loaded dice. I just want to drill down on the loaded dice ones. Here's another loaded dice DJT one. They're all bullish loaded dice. Oh, this is a different one. This is similar to loaded dice, though. This is called a broken wing butterfly. But anyway, it's a bet on bullish prices, and the price is pulling back, so it's down a little bit, but you could do this type of trade for a credit. I love these types of trades. We'll have some content on those as well. That trade, you're selling 2 options to finance 2 options. Let's see what else we have on. Or let's see what else we've been looking at. The bullish Trump year-end trade. Maybe this is actually the one I put on election day because they always say the Trump trade is Russell, smaller stocks. Okay, so I just simulated it out to January. You'd have to have $4,000. It gave you a freaking massive buffer, like a 5-6% buffer, and if we get a rally into the end of the year in Russell, you're on board for the ride. That's a nice trade. I'm just simulating as many of these in here as possible to use for content, for teaching content. But I mean, lots of these ones I put in here for teaching content, I wish I would have done, like this one. I mean, these mega bull DJT volatility spreads, oh my gosh. I did have on one of them, but I didn't have it on enough times. That's the rule in trading. Anytime you have on a winning trade, you don't have on enough contracts. Whenever you have on a loser, it always seems like you put on too many contracts. You're like, why did I play 20 contracts when I usually play 10? You get the loser on the 20. Sometimes you cut back to 5 or whatever. It's Murphy's Law. Murphy was an Irishman, but he traded the market. He was a market trader for sure. He was a day trader. But yeah, this clusterfuck strategy, I can't believe I didn't put this on more times, but it's up. Anyway, everything's up. All right. We'll look at some of the expired or closed loaded dice and see how they're doing. So this one we had content on. It was a loaded dice, or it was a max convexity and BABA. They had earnings. 1-day trade, $50 winner. Applied Materials, 1-day trade, $2,000 loser. Disney, 1-day trade, $1,500 winner. Planeteer, oh, that's Jay's version. Here's my Mara earnings play, $90 winner. Earnings play, DraftKings. Well, we can't see it after it expires, but it was a 3-legged loaded dice. $176 winner. Square was a 3-legged loaded dice, $118 winner. Abney was the last one before AMAT that was a big loser. Here's one, a bullish loaded dice trade that was a $754 winner. Here's a pro-Trump trade that was a $570 winner. That was a loaded dice also. And here, this one's a great one. This was an Amazon earnings trade, a 4-legged loaded dice. I copied off Jay, $1,200 winner. I wish I would have made content on that one. This one on Planeteer was a $1,700 winner. This one's a $700 winner. Free money spread, 1,000. For a while, I just couldn't lose. I mean, because look, bearish Planeteer, broken wing butterfly. I mean, it was obscene. Anyway, all right, guys. Well, I just want to give you guys some bonus option content. It's the weekend. I wanted to kind of get into the weeds and explain when to do a more complex trade where you're multiple legs buying and selling, and when just to do the normal, and when to do a normal trade, and how to compare it. Like I say, on this type of trade, not this one. On this USO trade, all you do is just take the single option, just exclude exclude the thing you sell, just look at the single option, and that's your alternative. But it's a low probability trade. But it's like when you do the trade the way I showed you to do it with the back spread, it's like you get this 4% free. That option's free. You're kind of hiding that option in another spread, calling it free. It's not really free, but it kind of is. Okay, so even though this just happens 4% of the time, if it doesn't really cost you anything to do, it's like a tree falling in the forest. But it's a perfectly legit way sometimes just to buy a call. Sometimes if you know the market's moving one way, just buy a call or buy a put. Sometimes it can be the mistake to get too fancy. But if you buy a call or buy a put every time you're trying to make a play in the market, you'll bleed your account to death. So, but sometimes it is the right move just to buy the damn call. And this one on SPY, this was a little bit more complex the way we had to compare it, but well, no, it isn't. I just did this. I brought up an option strat, the three-legged trade. If I ever suggest a three-legged trade for you guys, which I do all the time, I'm going to start a subscription service and start sending them to you guys, email them to you guys, but I'll just send you the option strat link. If I send you the option strat link, you'll have this. All you have to do, hit exclude, and that's what this, even though this trade only has a 16% chance of profit, you're essentially, to me, that's like a free shot. You give me a free shot at the market blowing up, I'll take it every time. Okay? Because look at this. If we excluded this one, just forget about that. Say if we didn't do that, here's what we're really doing. It's just a put spread. A put spread is just it's what Triple QY does every day. They don't do a put spread. They sell puts, but they're just selling puts. Selling puts is bullish. You have fully capped upside, but you make a good income. That's all the trade is. Essentially, you're doing. You're essentially risking 1,500 to make 282, but you're making a deal with the devil. And this little white line is your deal with the devil. You're adding a little bit of loss to it. It moves it from 1,500 to 1,800 or something. But see this white line, and you also, when you take off a little bit where you're capped at a smaller amount. You have a smaller credit, but then, like I say, the 16% of the time when your free option kicks in, boom, then the white line takes off up there. So let's see, I'm gonna add this back in. So this way we could do it. We have $282 in our pocket right away. This way we only have $196. So we leave $90 on the table. We add $90 to the risk on this side. So instead of risking 1,500, now we're risking 1,600. Okay. But in return for that, we've created a profile where we can make money over a wide area, like an iron condor, down 1.3%, up 2%. You make money just like an iron condor. It's just like having a big condor on. If you're comfortable doing condors, it's the same thing with bonus upside, free upside. And that's what makes me excited. I don't need HIMS. This kind of stuff does it for me, guys. That's why I didn't even know what HIMS was. But anyway, I had to look it up whenever Jay bought it. I mean, then when I Googled it, then it occurred to me, I've seen the ads on TV, of course, but I didn't know they were a public company. All right, guys. Well, let me know what your favorite option trade is. If you made it this long, I really appreciate you guys. You guys deserve a reward. But I really do appreciate each and every one of you guys. And I hope that you like this episode of Bone Up on Options with Max.